Good. Well, good afternoon, everybody. My name is Rich Harvey, CEO and founder of Property Buyer. I'd like to welcome Terry Ryder, founder of Hotspotting. Terry, great to have you on our webinar today.
I love doing these webinars with you, Rich. We always get a great audience and we always talk about the issues that seem to matter to real estate consumers. So we always get great numbers.
Yeah, it's great. Look, we've got a packed program today, folks. We're going to be talking about interest rates, the future of the market, structural demand, infrastructure investments, and where we see the market going in 2026 and beyond. So we've got a packed program. So I'll just share my screen, Terry, and then we'll just talk to a couple of points. But I want to kind of firstly talk a bit about the interest rate rise that we had yesterday. Obviously, that's had a significant impact on people's psyche. And last year we were talking about rate cuts, and then toward the end of late November, December, the inflation rate printed well above 3% band that the RBA was normally comfortable with. And so they said, oh, the narrative changed. And it was looking like a rate rise in February, which has materialized yesterday. So we're now back at 3.85% cash rate. So I just want to talk briefly, Terry, a little bit about what that means for property prices. And I'll just bring up a slide here, which generally shows just how interest rates sometimes are not always negatively, right? Interest rate rises are not always negatively correlated with property prices. If we look at just the last 5, 6 years, and I know we've had the COVID rebound, but we also had 13 interest rate rises, obviously off a very low emergency rate from 0.1, but up to 4.35% over that time period. But over that same time period, I'm talking nationally on average, which masks the big variations on some markets that did 20 or 25%. We had a 9% rise, Terry, over that time
Mm.
period. So what I'm saying is that just because we get an interest rate rise or two, it doesn't mean the market's suddenly going to implode. What's your thoughts on that?
All right, I totally agree. And if you study history, you can go back to the 1980s through the 90s, the first part of this century. There's a lot of evidence that
Well, I'll pull up the next
rising
slide.
interest,
I'll pull up the next slide to this point. You can talk to this slide, actually.
you know, rising interest rates do not cause property prices to fall,
Mm.
and falling interest rates don't necessarily cause property prices to rise. The message is that there are far bigger forces in play in the market than what's happening with interest rates. But economists tend to think it's all about interest rates, and I think that's why they continually get it wrong if they're forecasting what's going to happen with property
Mm.
prices.
Mm. Mm.
Um, some of them have got the message. I
Oops.
think the
Sorry,
the
not too far.
the the reaction I've seen in media today to the interest rate rise has been quite muted in terms of what people are saying about the impact
Mm.
on the property market. In the past, we've typically heard, the property market's going to crash because there's been an interest rate rise. We're not seeing that in the commentary today in
Mm.
most cases. And I think the message has got through. People have looked at what's happened in the last 5 years, but also what's happened right back to the 1980s.
Mm.
The end of the 1980s, we had the highest interest rates of my lifetime. Mortgage rates went up to 17%, and the property market boom just kept on going and going, even with all the interest rate rises that occurred through that period. The early part of this century, 2001, 2003, 4, 5, we had a national property boom at a time where interest rates were higher than they are now and rising. Um, so, the message is pretty clear that rising interest rates do not mean falling property prices. There are other forces in play that are much more powerful.
Mm.
And right now, we've got this imbalance between supply and demand, and we can talk about why supply is so weak and why demand is so high. But yeah, it's a more powerful equation than
Mm.
the cash rate.
Yeah. The other point, just to make on this chart here, Terry, is that we saw, as you mentioned about the resources being commodity boom, and we saw mortgage rates gradually rise from 6.1% in 2002 to 9.6% in August 2008. And then we had the GFC, where we saw the settings relax a bit for that year, but that was a very depressed market for the property market. Great time to buy property, by the way. I remember buying 3 properties that year. But then we also see some measures in here that have a more dramatic impact on the market, and that's particularly APRA around the Australian Prudential Regulatory Authority. Now, when they step in and curtail lending, that has a very dramatic impact on borrowing, which has a dramatic impact on people's ability to borrow and therefore property prices. So we
Yeah.
saw that where
Yeah.
they increased the buffer rate or the 30% limit on interest only loans, but also when they increased the limit on investment spending and also the buffer rates. But those kind of impacts have equally, if not more, impact than interest rate rises.
Yeah.
So, as you say, Terry, it's not just the interest rates. There's a whole host of other factors that affect consumer confidence, that affect the economy, productivity. So I think investors need to be aware that they shouldn't just be single-minded, that interest rates are the only factor determining the projection of the property market.
Yeah. Yeah. And yes, and as I said, the commentary that's out there.
Let's see if I can get everyone back on again. Sorry. Sorry, folks. Looks like my internet just suddenly dropped out. Typical NBN, unreliable all of a sudden. So hopefully we'll get Terry back on. There he is. Thanks, Terry. Sorry about that, guys.
Something mysterious happened with the internet.
I don't know there. So sorry about that, folks, but we'll get back in. We're recording again. Now I'm just going to bring up the slides. Where were we? We were talking, actually, I'll just start that again. Sorry, Terry. Where are we? There we go. Is that one? I'm going to share my screen, haven't I? There we go. Share number 2. There we go. We're back into it. So I think we'd kind of covered off most of what we were talking about, Terry, with regards to the interest rate factor. Was there any other key points you wanted to make about that?
No, I think we covered it pretty well. I think that
Okay. Yeah.
the impact is going to be muted. We just have to wait and see whether there's going to be further rises.
Yes. Yeah.
But I would say that what we saw in 2023 was constant rises in interest rates, and the forecast was that property prices would drop a lot, but they didn't. Property prices rose. In
Yes.
2024, we had persistently high interest rates at the very high levels they'd risen to after 13 rises, and the forecast from the economists was that prices would fall a lot, but they didn't. They rose. So I think the message we get from that one interest rates rise, even if there's a couple more to come, isn't going to have that dramatic impact on property market or prices that some would forecast.
Great. So Terry, maybe I'll get you to share just a bit of a background on what's happened in terms of the property market the last year or two, just which markets have really performed well, which have been average. Yeah, it'd just be good to take a quick step back and look at the last 12 months compared to what some of the commentators were saying, please.
Okay. So I'm just sharing my screen. Basically, what I've done is I put the price results for calendar 2025. So we just had the year that's ended, and we've put the data for annual growth for the year calendar year 2025 from 3 different research sources. So here we've got the house price results from PropTrack, Cotality, and Domain, and over here we've got the unit. So we'll just look at houses to keep things simple to start with. One of the interesting points is they all have different numbers, and people do need to keep that in mind, that none of the figures that are published, they tend to be treated as gospel truth by the media, but they all have their own methodologies and they come up with different numbers, and sometimes very different. For example, down here you can see Hobart rose 6.8% for the year according to Cotality, but 10.3% according to Domain. Darwin rose 14.7% according to PropTrack, but 22.4% according to Domain. That's quite a difference. So always keep that in mind when you see data published by media quoting a source as if it's the absolute truth. It never is. It's all dodgy data to a certain extent. But overall, they do tend to show similar patterns. So let's look at the messages that we get from this data. Looking at the house price data, to me, this is a very unusual situation. I've been researching and writing about real estate across Australia for more than 4 decades, and it's very rare to see a year in which everywhere is showing really good growth. That's an unusual. We normally have what I call a 4-speed market, and we had that in 2024. We had some markets had a boom level growth, some markets had moderate growth, some markets had no growth, and some markets had falling prices. But in 2025, everywhere had a pretty good level of growth, which is an unusual level of universal strength across property markets in Australia. So the worst result was Melbourne, rising around 5% according to PropTrack, almost 6% totality, 7% demand. But that was actually the overall the worst result of any of the market jurisdictions with a regional capital city across Australia, which indicates a very, very strong year for property prices. And of course, the best, here we have Perth, according to all three sources, very good level of growth. Darwin, according to some sources, the leader nationally on prices in 2025, very good level of growth. Brisbane did very well. Adelaide pretty solid still. After 5 years of growth, Adelaide's still rising. So yeah, an impressive level of strength universally right across the market, which, as I say, is unusual. And so that's the sort of momentum that we're carrying into 2026, that universal strength. Now, some of the other points are shown by the data. In terms of house prices, if we look down here, the city average and the regional average, the regions have outperformed the capital cities, and that's been a factor for a number of years now. We've seen quite a lot of population drift to regional markets. They offer a level of affordability that big cities don't. That's not to say that the capital cities haven't done well. These are the capital city averages here, according to the three sources. They're all around 9%. That's a pretty good year. It's just that on average, the regional markets have done a little bit better, or according to the domain figures here, quite a lot better. So again, it does illustrate the universal strength right across the country, but the regional markets have done pretty well. And if we look here, regional New South Wales has outperformed Sydney a little bit. Regional Victoria has outperformed Melbourne a little bit. Brisbane's a bit ahead of regional Queensland. It's all over the place with Perth and regional Western Australia, but both markets have done very well. Adelaide's a little bit ahead of regional South Australia, but again, both markets have done well according to that set of figures. But this set of figures is different. Lies, damn lies, and statistics, people. You just can't place too much faith in the data. But regional Tasmania and Hobart, pretty close, in fact, but the region's certainly challenging the capital city in that case. So that's a continuation of what we've been seeing in recent years, that regional markets have done very well. If we come over here to the unit markets, so the best and the highest numbers of all are regional unit markets collectively. And according to the domain figures, there's quite a difference. Although with the other sources, not so big a difference, but they all do agree that regional unit markets have outperformed capital city unit markets. But again, city markets haven't done badly. The worst number there is 5.3% rise in city unit prices, which isn't a bad year. It's just that the regional markets have done a little bit better. And that also has a nice segue into the other point that's worth noting, and that is that unit markets are challenging house markets more and more on price growth. And that's a really important paradigm shift. It's been evident for the past 2 or 3 years in our research. I think it's a trend that's got longevity. It's here to stay. Affordability is one reason. I'll be interested to get your thoughts on it as well, Rich. I'll just firstly just touch on some of the numbers we see here. It's not in every location, but if we look at the Brisbane numbers, you see that the growth in unit prices was higher than the growth in house prices. Both did very well, but the units were better. With Perth, generally speaking, the growth in unit prices was a little bit higher than the growth in house prices. With Adelaide, same thing. Regional Queensland, it's pretty much line ball, but you get the message there very clearly that we're seeing much better price performance by unit markets than has been the case in the past. And for investors, that can be good news because you do tend to get better rental yields of units. They do tend to be more affordable to buy. And if you're getting comparable capital growth, that's a kind of a win-win-win scenario for people struggling with the affordability equation at the moment. Your thoughts about that, Rich?
Yeah, it's a really good point, Terry, that the unit markets have often been seen as subservient to housing properties, houses generally. But I think the next 5 to 10 years, the unit market is going to do very, very well and above the usual long-term averages for a couple of reasons, Terry. And again, not going to happen everywhere equally, but the general principle is that the replacement cost of a unit and the construction cost of a unit has gone up so much, somewhere between 40 to 50%, that it's now not as viable to build the same types of properties. It's also a more affordable end of the market, and that affordability is going to drive higher demand at the lower price points. So, where Sydney's median somewhere around 890, 900,000 for an apartment compared to say 1.75 for a house, it's like more than double the price to get a house. It's going to find that that unit market is in high demand.
Yeah.
So again, to the caveat here, or the warning for investors or home buyers is, oh, just because Rich says a unit's going to perform well, I'll go and buy a unit. No, don't buy it anywhere. So again, only buy units in areas where there's constrained supply, where they're more boutique units. Don't buy in blocks of 200, where
Yeah.
it's the same ubiquitous kind of boring design. Don't buy on Parramatta Road, two-bedroom units in Parramatta where there's thousands of the same thing, right? You've got to buy in suburbs where it's got an attractive lifestyle appeal, great connectivity to transport, shops, education facilities. So, yeah, I think the key point here, Terry, is that units will perform quite well because they're driven by the higher replacement costs now and higher construction costs.
Yeah.
Mm.
Yeah, I do reinforce your point about do need to be fussy about location choices with units. You also need to be a little bit careful about the type of unit product. Units can be anything from townhouses to a little a development of single level units, maybe 6 or 8 in a little block, to 50-story high rise. And certainly it's those more boutique style units that I think are the ones that are going to serve people best. Over time.
Mm.
So
So
that's
Terry, sorry, go on. Mm.
I was going to move from to the next thing I wanted to show, which was that's the situation that you can see on the screen to the end of calendar 2025, just to bring it up to date with the latest data, because we now have the latest price figures from the usual suspects, including PropTrack and Cotality. These are the Cotality figures from the 1st of February. Their take on what happened in January, and sort of takes it a step further from what I've just shown you for the annual figures for the end of 2025. You can see that in terms of this is the growth in dwellings of the various markets. You can see across here that every one of the market jurisdictions, regional and capital city, showed some level of growth in dwelling prices in the month of January. And for the January quarter, again, every one of the market jurisdictions had a pretty good level of growth, although Melbourne was barely in the positive in that quarter. And then if we look at annually, so the 12 months to the end of January, you can see that the worst performance in Australia was Melbourne, 5.4%, and Sydney, 6.4%. But if those are the worst performers in the country, it does say something about the overall strength of markets across Australia. And the best we've seen, Darwin houses at or dwellings at 19.7%, Perth at 18.5%, Brisbane 15.7%. And we've got regional Western Australia 17%, regional South Australia still very strong 12%, regional Queensland 13%. There's a lot of strong markets in the country, and reinforced by the fact that in the month of January, which is not normally probably a hot month for real estate, people are coming back from their festive season break, so it takes a while for markets to crank up again. I don't know if that's your experience, Rich.
Yep.
That seems to me that it's starting earlier and earlier every year, that people are really getting into it, and that's certainly been the case this year. There's a lot of strong buyer interest out there quite early this year.
Yeah, definitely there's a seasonality factor. A lot of agents kind of wrap up their campaign on the first week of December, and you don't normally see new listings until the third week or even after Australia Day. But I have seen this year a lot more agents come back the middle of January and start campaigns, so that the first auctions are going to be sort of the second weekend of February. It really just depends. Some years start with a bang and other years are a bit lackluster, but I think this year is going to have pretty strong momentum, gauged by the volume of listings coming online.
Yeah. So what I've just shown you up the top here of the totality figures is dwellings. Then they break it down to houses and units, so we can look at the annual figures for house markets. The only exception to the growth story is regional Northern Territory, and that's really just Alice Springs. There's no other market of substance in the regional part of Northern Territory, so that's probably can be ignored in terms of the overall story. The leader here is Darwin, up more than 20%. I would like to touch on that
I
a
was going to
little
ask you,
bit.
Terry. I was going to ask your opinion, and I guess also the caveat is often you see the financial planners put up something as past performance is no guarantee of future performance, and I guess that's also a lot of what we're unpacking in today's discussion. But tell me your thoughts on Darwin personally. Would you invest in Darwin? Why or why not?
Look, I would rather invest somewhere else. And the reason is that historically and now, I think that there's a volatility in the Darwin market. It's not underpinned by an economy that's as strong and as broad as other places. And I think that the spike in property values, the spike in buy demand that we've seen in the past 12 months in Darwin is very much driven by, I think, a small number of buyers agencies who are sort of have it seems to me a policy of going into a market like Darwin and just buying everything that moves, paying whatever price is necessary to beat the competition and cornering the market to a certain degree. And it's you might argue that the prices in Darwin have been artificially inflated by that factor more so than anywhere else in the country. And you have to question the longevity of that Darwin boom.
Mm,
Whereas
yes.
over here with Adelaide, still rising. Adelaide's been producing double-digit growth in its house prices for 5 years now, and it's still a strong market. You know, there's a real strength and longevity to that Adelaide situation. We've also seen Perth show a great deal of resilience. It's been rising for 3-4 years now and still strong. I just question whether we're going to see Darwin figures like that continue show the same level of continuity and longevity that we've seen in markets like Perth and Adelaide, and some of these regional markets. Regional South Australia has been showing good growth for 5 years, regional Western Australia as well, underpinned by very strong economies. Just a little bit concerned about whether we're going to see Darwin perform
Yeah,
in the
my
same
view
way.
on Darwin, Terry, is I think we discussed it the other day, is just around the volatility of the workforce, a lot of FIFO workers, and also the sort of the depth of employment experience there, and also the wages. So it does tend to be a more fickle market, and also its amenity. You know, it's a very hot tropical climate. So obviously that sort of can be a detriment to certain areas like that, but it's more around the infrastructure, the population growth, and the diverse employment and income levels that would relate to why that wouldn't be an optimal investment versus other areas. Mm.
Yeah. I think climate might be a factor. We're going to move on shortly to talking about what we expect to happen in 2026 and beyond. And one
Mm.
of the standout features is the rise of Tasmania. We'll talk about a little bit, and
Mm.
partly driven by people moving there, seeking a cooler climate. Whereas with Darwin, obviously, it's like seems like it's 30 degrees plus,
Mm.
even in the wintertime, and very, very hot in the summer.
Yeah, it's it. It's it. Just also for everybody's information, we are recording this session, and that'll be made available along with a copy of the few slides we're putting up today. So, yeah, hopefully my internet will work properly. I've switched over to my mobile phone instead of NBN. Hopefully Telstra's more reliable than NBN, but we'll see. Yeah.
Okay.
And if you do have a question too, by the way, just pop it into, some people have already done it, into the Q&A box, and we're going to open it up for Q&A for 15 minutes at the end of our presentation today. Mm. Mm. Terry, is there anything else you wanted to cover off
Okay,
on that?
so that's really my summary. No, I think that covers where we're up to date. And of course, as I often say to people, the past does not inform the future, and you've just alluded to that yourself. today we really want to focus mostly on what we expect to happen in the year ahead and beyond, because we do tend to take as I know you do, Rich, a longer term view of real estate markets, as everybody should.
Mm.
So that's our main focus today.
Yeah, great.
So I can perhaps stop my share and
Yeah, yeah, great. So that'll be great, Terry, if you just take it off there. Thank you. So really good update today. Before we get on to projections for the next sort of 1 to 5 years, I'm going to talk about a report that we've recently produced that many of you might have already read. But I just want to have a discussion with you, Terry, about the $1.2 million housing target that the federal government set just over a year and a half ago, and whether that's an achievable target, whether that's going to be a failed target, and where that's going to be. So, in my view, it's great to have a target. It's great that the government is trying to address the housing supply problem in this country. But it's going to require a lot of more coordination, a lot more tenacity, and better policies than what's happening at the moment across 3 levels of government.
yeah,
So already we know that the target is well behind. My report, we're estimating that we're going to be about 400,000 dwellings short of that target. And the HIA and the Housing Council are all saying that we're going to fall short of that target. So the question is, why do we have a target and what's going to happen if we fall short? So in my view, the reason we're falling short of that target is for a couple of key reasons. And I've mentioned one of them, and that is construction costs are much higher and continue to escalate. Now, they rapidly escalated somewhere around 40 to 45% since COVID times, depending on, the type of material, timber and steel and everything else went up dramatically. There's also the issue of zoning. Now, in New South Wales and in Victoria and certain areas around the country, there's new zoning laws in around properties within 400 to 800 metres of shopping centres or train stations are rezoned for low to medium residential density. So that's going to allow more missing middle properties. So that's all well and good, but will those properties actually get built, Terry? That's the question. And
yeah,
the issue is, even though they've rezoned some of these areas, it's just not viable for a developer to go in, do his DA, he or she do their DA, and then produce a profitable outcome. So the lenders won't lend on a development project unless there's a 20 to 25% ROI, because there's got to be buffers. Anyone who's done development knows there's going to be delays and cost escalations. So, and you've still got councils being very, very problematic in approving things. And I can speak from first-hand experience trying to get a development approval through at the moment. It's very difficult. So, Terry, what's your view on how far short we're going to be of the target and the reasons for it?
yeah. I think we're going to fall a long way. We're already, as you point out, a long way behind. A couple of years into this 5-year period. You asked the question, why a target? Like, I think it was a press conference opportunity. They haven't really done anything to make the target achievable. It's all very well to have this target. They keep saying we're building $1.2 million homes in 5 years. They're not. Federal governments don't build houses. They hope that the industry will, but they haven't created the conditions to make it possible. We do have a shortage of everything. Costs have risen to the degree where projects are just not viable. The productivity in the housing industry is half what it was 30 years ago. It takes twice as long to build homes now, and that's because of the bureaucracy. And the state government's constantly tinkering with the design of homes and stipulating homes be more environmentally friendly or more aesthetically pleasing or more accessible to more people. And they all add to the costs. It's got to the point where projects aren't viable. The most interesting commentary that I could put into that argument is that very recently we found out that Landcom, which is the state government's developer in New South Wales, has quietly scrapped 3 or 4 very major housing projects that it was been planning for years in Western Sydney because they're not viable. The numbers don't stack up. Now, if the government developer can't make a project stack up, how hard is it going to be for private developers and builders? Because the costs are so high and the bureaucracy is so intense. But so media gets excited about building approvals, but approvals aren't commencements and they're not completions, and that's the difference. We've got, as you pointed out, lots of approved projects that aren't proceeding because they're not viable, including the ones that the state government developer was doing in New South Wales
Mm.
until they decided they weren't. So
Very
we're going to
interesting.
continue, and the upshot of all that is we're going to continue to have a chronic shortage of everything that's important. And adding to that, the latest figures came out from SQM Research about listings of properties for sale yesterday. And in annual terms, they're down hugely in every market in Australia. Nationally, they're down 11%, comparing now with 12 months ago. So
Mhm.
there's a shortage of listings of property for sale. There's a shortage of rental properties, and we're not building enough new homes. So the
Interestingly,
supply,
the figure of 11% from SQM, Terry, at the end of last year when I was doing my presentation updates, the figure from Totality was 19%
yeah,
below the 5-year average for total volume of listings.
yeah,
So that's a massive number,
yeah.
in my view. Mm.
And and what I'm hearing, and you obviously you know this as well as anybody as a buyer's agent, but I've been talking to a lot of buyer's agents, and they all complain about the shortage of listings, and when a decent listing comes up, how much competition there is for that good property that's for sale. There's
Correct.
more than ever before, and that's just happening everywhere, it seems.
Exactly. Well, I mean, my team in Brisbane say they're pretty much seeing a property sold within 1 week. One Saturday will go by and it's sold. So the thought of the buyer having 3 to 4 weeks to take their time and mull over it and then maybe make a few offers, it's always going to be a multiple offer situation, particularly in the Brisbane market, for example.
Yeah,
But coming back to this target, I just want to talk a little bit more around buyer demand and what's driving buyer demand at the moment, Terry. We haven't really talked a lot about the new home assistance scheme. So the 5% deposit scheme that the government brought in early last October, where you can have,
mm,
instead of a 20% deposit, you'd pay LMI once you borrow more than 20%. Now you can buy a home with a 5% deposit and the government will cover the cost of the lender's mortgage insurance. Now, there's different caps in different states for how that works. But Terry, we've seen firsthand on the ground how much that is driving the lower end of the market. It's insane. It's just going to
yeah,
push
yeah,
property prices to those caps very, very quickly, Terry. So what are your thoughts
yeah.
on that sort of a scheme?
Yeah, well, I mean, it's typical of government, typical of politicians, rather than deal with the core issues. Like we've just talked about the high cost of creating it. That's the core issue.
Mhm.
Rather than deal with that, they'll throw grant money at first home buyers as a vote winner, but they're actually making the problem worse. They're making affordability worse. And there's no doubt that it's not just the 5%. There's also another federal scheme. We only need 2% deposit. That's where you sort of share ownership with the government. But there's also the state government schemes where there's stamp duty concessions and there's grants available. Massive advantages. I mean, I'm always so amused to see all the rhetoric in media about we've got to get rid of negative gearing, we've got to do something about the so-called capital gains tax concession because investors are outbidding first home buyers. I think the opposite is true. The great advantage right now is to first home buyers, and that's what's driving up prices in the more affordable areas is this massive increase in demand from first home buyers because of the federal schemes in conjunction with the state government schemes. And it's just making the affordability problem worse. But that's one of the reasons why we have high demand and rising prices. It's not the only reason. There's a couple of other big ones, but that's a very big one.
So Terry, in all of your research reports, which are excellent, by the way, for any of our viewers out there, they should buy them. But you often talk about the getting on the infrastructure gravy train, and
Yeah.
you've said there's like almost 1,900 infrastructure projects out there at the moment. Can you give us a bit of a flavour for what's going on in the
Yeah.
infrastructure world and how that's impacting the property market, please?
Yeah, I mean, it's never talked about in media or by economists because they don't really understand too much about residential property. And this is the
Mm.
big one for me, and it's never discussed, as we've got an unprecedented level of infrastructure investment happening around the country. And that's hugely impactful on residential property markets because it generates economic activity, creates jobs, and improves the amenity. And if you've got a major new hospital, $1 billion hospital built in an area, that makes an area more desirable because of a huge increase in medical facilities. But there's like 5 or 6,000 5 or 6,000 jobs and running the thing. People like to live close to where they're working, and there's an influx of people from other parts of the country to work in that facility. And right now, there's over 100 of these big hospital projects happening around the country. Then you've got the road projects and the rail projects, which improve access to locations. That's even bigger. The sum total of all the infrastructure projects happening across Australia right now is 2,000 billion dollars, $2 trillion, unprecedented, and that's generating so much demand. So where these projects are happening, buyer demand is rising, and that's a big factor.
Huge. So, and it's also taking labor away from residential property developments.
Yeah.
So, if you think about how many electricians, sparkies, carpenters are being used to build the roadways, to build infrastructure for the Olympics, all of our metro in Sydney, all of those things. So, there's very high demand for labor, which is taking away from labor that could be used elsewhere. So again, that adds to competition, which pushes up prices and inflation across the economy.
It's a huge part of the shortage of homes we have, and the reason why we'll never meet that 1.2 million target is that those big infrastructure projects are sucking all the the tradespeople out of the housing industry. They can earn better money on the big ticket infrastructure projects, and that's a big part of the problem.
Yeah. So I think, Terry, just to sum up, I guess some key points here is that, and again, I've addressed all of these in my big housing report for the next 5 years and talked about the big supply crunch coming. All of these supply issues are entrenched in the system, and no matter whether the government decides to fiddle with negative gearing or change capital gains tax or whatever, we're still going to have supply problems. So the message here for investors is invest for the long term. Don't let the noise of policy or Trumpism or whatever get in the way of making a good decision. We're going to have a structural supply with property for the next decade. And so it's a really prime opportunity for investors and home buyers to get into a market and ride out these kind of cycles that are happening.
Yeah, I agree. Absolutely. And the factors we've just discussed, we haven't even talked about the high population growth levels, but that's another factor. But what you've just said is a far more powerful and important factor than what's happening with interest rates right now. And that's why what the Reserve Bank decides to do this year with interest rates is going to be not irrelevant, but far less important than the factors you've just articulated.
So, Terry, I might just share my screen and take everyone through a couple of predictions, if I may. Just looking ahead now, let's put on our glasses and binoculars, and let's have a look at 2026 and beyond to see where we start. And I think this year's starting with a bit of momentum. Obviously, a little tap of the brakes with the Reserve Bank interest rate yesterday, but nationwide, I think we're going to still see positive growth. So I want to look at firstly one of the commentators, and that's Louis Christopher from SQM, and I've put this up before. Now, what I want to put, the reason I'm putting this up is that Louis, bless his soul, he hasn't actually put in here a scenario. Usually does 4 assumptions here. So he's got 4 assumptions. Sticky one, first case is base case where there's a rate cut or 2. Second one where there's no rate cuts. And then we've got global spillover and then an economic rebound. So it's going to be, this scenario these are all defunct now, to be frank. And this scenario 2 is probably going to be shave a few percentage points off this one is where I see the outcome. But
so he didn't have a scenario with a rate rise. That's what
rate rise. Sorry, that's right. Rate rise. That's what I meant to say. Yeah, it didn't have a scenario with a rate rise. So what I'm saying is this scenario 2 here, you're going to have to shave off a couple of percentage point growth here. But all of these cities, to his point, though, all of these cities here have very, very strong positive growth. So that's just a case in point. I won't go through them in detail, but if we look at also his rental forecasts, again, really strong rental forecasts. So sometimes, Terry, we just focus on housing price growth. We don't focus on rental increases. Now, for the investor that's thinking of retiring and relying on that rental income, this is a really important number to think about. And often we've sort of just thought, oh, it's just going to rise 2 or 3%. No, you can see here, rents have been rising in Perth up to 7%, Brisbane 5%, Darwin 9%, really strong increase. Look at Hobart, 6 to 10%. So there's much bigger rental increases than people are perhaps anticipating. And that's a really important thing
Yeah.
to think about with investing. Don't just focus on the capital growth rate increase. Let's think about the rental shortage and what the rental market's going to look like in the future as well. Now I've done a lot of
Yeah.
predictions. So,
Because there's no,
yeah, go on. Sorry, Terry, go ahead.
um, I often say to people when you're looking at when you're buying something at the rental return, don't just think about what it is now. Think about what it might be in a couple of years' time,
Mm,
because rents are continuing to rise and there's no end in sight. We've had vacancies hovering around 1% for 4 or 5 years now.
mm,
The federal government and state governments haven't moved the dial on
yes.
that one iota. In fact, they've probably made it worse in some locations with some of their legislative moves and their taxation moves.
That's it. Exactly. Really good point. So, anyone who's on our distribution list would have seen that we've produced this report, and I've been helped by Husman Arif, who's our head of research and data analyst in our team, to produce this report called the Australian Property Market Outlook 2025 to 2030. So, what we've done is not just take a 1 year view, but take a 5 year view of the market. And I've interviewed around 20 economists and other experts across the country to come up with what I believe will be the outcome in the next 5 years. So here's a little drum roll. Here's the predictions on what we're saying. So what we're expecting to see is pretty significant price increases right across the board. So this is the 5 year growth figure. We're expecting Sydney houses over a 5 year period to go up around 27%. We're expecting Melbourne houses to go 29%, Brisbane houses 31%, Adelaide houses 30%. So all very significant growth. Now, bear in mind, some years you might get a 7, 8% growth, and other years you get a 2 or 3% growth. But on average, you're looking at a 6 to 7% growth in a lot of these markets. So again, it just goes to show that you don't just focus on 1 year, but focus on a longer term period. Essentially, I always advocate buy and don't sell unless you have to, and you should be looking at a 10 year period hold minimum to maximize your capital growth. And what's interesting is when you hold for 20 or 30 years, the capital growth, Terry, is exponential. My own portfolio properties that I bought over 25 years ago have just more than tripled. It's incredible to see just the value that they are today compared to what you paid and smashing the yield.
Yeah.
Mm,
Yeah, it is extraordinary what property does and continues to do. In the last 5 years, in the best locations, we've seen values double in 5 years. The old cliche in real estate used to be that, values double maybe in every 10 years, but the best locations in the last 5 years have doubled in that 5 year period.
mm, mm,
Not everywhere, of course, has done
mm.
that, but
No,
and you can't assume that it's going to happen in the future. The past does not inform the future necessarily.
exactly.
I think the growth will continue, just that the leaders will be in different areas. And
Mm,
I'd
mm.
have to say that you're predicting some solid growth in the markets on screen, but I would say those numbers are quite conservative. In fact, and probably deliberately so. You don't want to overstate.
Exactly, exactly. I don't want to overstate it. Rich, you told me that we'd do 31%. It's done 35, so.
Yeah.
Yeah. So again, I'll share all of this so everyone will have access to this report. It'll be a download link. You can download it, read it to your heart's content, and digest it. So, Terry, I just want to have a discussion around this particular question. And I get asked this question every day of the week, and Pete Domjan, our Director of Client Strategy, gets asked it too. Rich, when is the best time to buy? When's the right time to buy? How do you respond to that question, Terry?
I say my response is it's the wrong question. The right question is, where is it a good time to buy?
Mm,
And I get asked that question all the time. Is now a good time to buy? I saw a headline in a newspaper yesterday. Is now a good time to buy? Wrong question. Big country, Australia. Lots of different markets doing different things.
mm,
As I pointed out, the current situation where there's universal strength is unusual.
mm,
Typically, we have markets, and even now we do markets at different points of the
mm.
cycle. The question is, try to find the place where it's a good time to buy early in the cycle. There are
Yeah.
plenty of places where, I pointed out some of those that have had 4 or 5 years of growth may keep on growing for a few more years yet, but not the right time to be buying in those markets. It would have been great to buy there 3 or 4 years ago.
Mm.
So where can you find locations that are early in that cycle where, say, Adelaide was 4 or 5 years ago and Perth was 3 or 4 years ago.
Mm.
Darwin was 1 year ago, perhaps. So it's buying at the right time and the right point of the cycle in markets that have got prospects for long-term growth.
Mm.
And that comes down to looking, and as far as I'm concerned, at the underlying economy. It's all about the economy that's existing locally, whether it's strong, diverse, creating jobs and attracting new population.
Exactly. Yeah. And I think you mentioned very early on in the webinar today about regional markets even outperforming some of the capital cities. I'd just like to ask you a couple of questions around some of the key markets or key regional markets. Let's start with Townsville. What's your thoughts on prospects for Townsville? It seems to have been a pretty strong performer, obviously got a big defence capability, multiple industries. Where do you see it going in the next 10 years?
Yeah, I think, and if I had to nominate one regional city as the epitome of everything we love about regional cities, Townsville would probably be my pick. There's a few other candidates, but it's got such strength and diversity in its economy. It's got a lot of manufacturing. It's got a huge government presence. It's got a huge impact from the resources sector. It's got a big education economy. It's got a huge military economy because it's got a RAF base and army base. Big tourism economy. It's got an export port. It's got an international airport. It's got it all, Townsville, and it's had, certainly until recently, a very high level of affordability in it, and you'd have to say that it's probably been the best performer in the country on price growth in the last couple of years. I mean, every suburb of Townsville sort of went up 20% or more in 1 year. So great market. It's going to be a great market to own real estate long term because of that underlying economy that's so strong and diverse. The best time to be there was a couple of years ago, but if you're buying there now, you're still going to, 5 years from now, probably be very happy that you bought in Townsville.
Exactly. Another market I want to ask you a little bit closer to Sydney is Newcastle and also the Central Coast. But firstly, Newcastle. It's
Yeah,
obviously about an hour and a half north. You've got great access to the Hunter Valley, some great lifestyle beaches. It's gone through a fair bit of gentrification.
yeah.
We've seen the new law courts, new university built right in the centre of town. The heavy rail's gone out. You've got the light rail through the city. What's your thoughts on the prospects for Newcastle, Terry?
Yeah, well, again, it's a great city, and it's bigger than some of our capital cities. It's got that strength and diversity of economy. It's got lifestyle. I think lifestyle is an important factor. I mean, if you look at the best performers over the last 5 years amongst the regional or any markets in Australia, they've all been regional. But lifestyle has been a factor, not the only factor. Strength and diversity of the economy is the biggest single factor. Infrastructure spend's important. But Newcastle's got that lifestyle element. It's got the river. It's got a magnificent wine district. It's got lovely horse country not far away. It's got beaches. So it's got all those lifestyle factors as well as the strength of the economy and the infrastructure investment that's so important.
Hmm. Okay. And what about the Central Coast? What are your thoughts on that? New South Wales, Central Coast.
Yeah, well, it's a beneficiary in particular of that trend we call the exodus to affordable lifestyle. And
Mm.
affordable is relative. Some people might look at Central Coast and say it's quite expensive, but relative to Sydney, it's still very affordable. And the big trend that I keep referring to is population has been drifting from Sydney and Melbourne, but it's usually typically doesn't move very far. So a typical move where someone is selling a home in Sydney, moving to the Central Coast, they can get a home of comparable standard for less money and have money left over, but they're within striking distance of the big city when they need to go there. And a lot of people are sort of working from home, maybe part of the week, but going into the office in the centre of Sydney or somewhere in Sydney for part of the week. So the Central Coast has benefited enormously from that trend and will continue to, keeping in mind that it's got a tremendous lifestyle. And I mean, if you look at a map of the Central Coast, it's just this conglomeration of ocean frontages and bays and lakes and rivers and little inlets, and it's gorgeous lifestyle stuff. And
Mm.
it's relative to Sydney, it's quite affordable and not
Absolutely.
far from Sydney.
Yeah, and interestingly, the yields are holding up pretty well there. Like I've got a property on the Central Coast, and I've been able to get some pretty decent rental increases and capital growth as well. All the time I've been holding it. So yeah, it's
Yeah.
proximity to Sydney, as you say, lifestyle appeal is really strong. A couple more regional markets, Terry, Albury Wodonga, and then Geelong. Tell us about Albury Wodonga as a market for prospects.
Yeah, it's one of those ones that's up there in my mind with, the Townsvilles and the Newcastles. Um, it's got that strength and diversity of economy. Probably the biggest strength of Albury Wodonga is its location. It's very strategically located. A lot of the businesses that need big warehousing, like the supermarket chains, have a big presence in Albury Wodonga because a huge percentage of the Australian population is within, a small number of hours driving distance. Sydney, Melbourne, Canberra, all within, reasonable distance for a truck to be moving stuff around. Big proportion of the Australian population. It's got affordability. It's got lifestyle. It's on the river, and yeah, and it's on also a big plus in its favour is the biggest national infrastructure project currently under construction is the Inland Rail Link, $35 billion project, and Albury Wodonga's on the route of that, connecting Melbourne to Brisbane via Albury Wodonga, Wagga Wagga, Parkes, Toowoomba in Queensland. It's going to be a big advantage being on the route of that very important piece of infrastructure.
Great. And let's go down to Victoria. Love you to give us your thoughts on Geelong, on Port Phillip Bay. Mm.
Yeah, Geelong, again, it benefits hugely from that exodus to affordable lifestyle factor. It's some people would regard it as part of Melbourne. We regard it as regional, but very well connected and very close to downtown Melbourne with good transport links. Lovely lifestyle factors, given that it's on a peninsula, so almost surrounded by water, not far from the surf coast. Relatively affordable compared to Melbourne, and its economy is very strong. It ticks all the boxes. It used to be that Geelong was, the old style economy. They made manufactured cars and they had smokestack industries, and it's transitioned very successfully to the modern economies where it's all about education and health services and IT. And it's also the headquarters for the NDIS, which is a big industry these days. So a lot of reasons to like Geelong as a long-term property play.
Great. And the last two I want to ask you about before we go to Q&A session. We've got a bunch of questions there to answer after this, Terry. But north and south of Brisbane, we've got the Sunshine Coast and then the Gold Coast. So Sunny Coast seems to have had a pretty strong population
Yeah,
increase, like rapid over the last couple of years. What's property prices doing up there, Terry?
yeah. Yeah, well, Sunshine Coast is probably at the right point of the cycle for people to be looking at it again. It was a national leader on price growth, say 2020, 20 to 2022, 23. It's had a bit of a pause and now it's starting to move again. It's quite an expensive market now because of that previous growth, but it's attracting a lot of population. In fact, the regional movers index, which sort of charts that trend, I've referred to a number of times with people leaving the big cities and moving to regional areas. The national leaders of capturing the most of that population drift are Geelong, getting population out of Melbourne, and Sunshine Coast, getting population from everywhere because people moving to Queensland. And so it's become quite a significant city. Had a big infrastructure spend, and that's ongoing. So it's going to be a great place to own real estate long term. The Gold Coast there was a time when I would never recommend the Gold Coast because it was so volatile. It had a boom bust thing going on
Yeah.
because of all the high rise construction. But now it's got the opposite problem because of what we said earlier about projects not stacking up. That's very much the case for 50-story high rise buildings. They're not being built the way they used to because they're just not economic to build anymore.
Mm,
What you'd have to charge for the units,
mm,
the market wouldn't pay it.
mm.
So the Gold Coast has got a shortage, and for the last 5 years, prices, Surface Paradise units for 10 years, no capital growth, but the
Yeah.
last 5 years it's taken off,
Mm,
and it's still growing. So the Gold Coast has had 5 years of price growth. It's still growing. It's an expensive market.
mm.
also the economy's broadened there. It's not just about tourism now. It's got a big education economy. It's got a big medical economy,
Mm.
and it's really thriving.
Mm. It's interesting, Terry. I was just up at the Gold Coast on the weekend, and all along the Gold Coast Highway, pretty much from Currumbin right up to Broadbeach. Anything, those blocks that face the beach between the highway and the beach, there's a huge number of high rises going up there. And I know a lot of them are actually sold off the plan, not just on completion, particularly to downsizers and retirees. And they've got like some of them have got almost whole floor apartments. They're like really oversized 200, 250 square meter apartments that are 3 bedroom plus.
Yeah.
And they're very popular for people
Um,
retiring to the Goldie
yeah.
from
Oh,
Sydney, Melbourne, or elsewhere now. So
well,
there is a market for those. Mm.
it speaks to one of the major new forces. And the markets are always changing. Like I say, change is the only constant in real estate. And one of the big changes, the big market forces, is downsizes. And
Mm.
apartment downsizing to an apartment with a lifestyle factor and a lifestyle location is a big force in the market now. And so those people, they want to downsize in terms of the amount of land they've got, but
Mm.
they don't want to downsize in quality. So the sorts of apartments you're talking about sort of fits that demographic quite
Mm.
well.
Mm. That's it. Terry, we've just got 15 minutes for Q&A. So just before we go to that, just want to make a quick shout out that if anyone on the call today is interested in working with Property Buyer, as you know, we're buyers agents. We only work for purchasers. We help you create a strategy to achieve your property goals, whether it's buying a home, an investment property, or a commercial property. And if you'd like to have a property strategy chat, a complimentary property strategy chat with Peter Domjan from my team, who's my Director of Client Strategy, all you need to do is just simply scan that image there on the screen, and I'll send it around as well. And that links straight into his diary. And we're also doing an offer today for anyone who's watched this particular webinar. We're giving a $300 discount off our standard engagement fee as well. So if you'd like to avail yourself of any of those offers, then please reach out and we'd be delighted to help. Terry, we've got a bunch of questions. I'll just see if I can find where's the Q&A. Can't seem to find it. Where is it?
Then you've got a chat and you've also got a Q&A down the bottom there.
No, I can't even see it for some reason. Do you want to pull up some questions, Terry? I can't seem to find it on my
Okay,
screen.
well, I've just got the Q&A.
Yeah.
Will a recording of this be available to view later?
Yes.
Yes, yes.
Mhm.
It'll be sent out to everyone who registered for the event, including those who are watching it live. So
Yeah.
that's the normal thing that you do, I think, Rich,
That's
isn't it?
right. Correct. That's right. Yep.
Yeah. Someone was pointing out that when I showed that spreadsheet with the 3 different sources of price data, Domain had no regional unit data, but there was a regional unit average. Yes, they didn't. They don't provide a sort of a breakdown for the regional markets for units, but they do have an overall figure for regional unit growth. So I just wasn't able to include the data they didn't provide, basically. Yes, yeah, that's just something that, whereas Cotality and PropTrack do have that breakdown for the individual regional markets with their pricing, Domain does not.
I found the Q&A now. I got it now.
Okay.
Evan's asking, hi, where do you think the best opportunities are in Sydney, say within a half hour of the city? Great question, Evan. It really depends on your budget. There's plenty of opportunities in Sydney to buy. Some great spots in the eastern suburbs, Lower North Shore, and all the beaches. It all depends on your budget. But yeah, Sydney, certainly trumps a lot of other cities for both lifestyle, job opportunity. Yes, it's expensive, but it's obviously driven by people on high incomes and very aspirational outlooks as well. So we think the market is going to do quite well in Sydney over the next 5 years. Samuel's asking, with record gold prices, is there any long-term relation with gold and Australian property prices? Fascinating. I never had that one before, Terry. Um, Generally, no, I would suggest, because property prices are driven by other factors very different to gold. Gold is seen as both a defensive kind of investment. People often retreat to gold when there's high currency fluctuations or share market fluctuations. And similar with property. Property is sometimes seen as a defensive or an inflation hedge. but I don't believe there's any strong long-term correlation between the two. Martin's asking, may I collectively ask you, what are your long-term thoughts on interest rates rising and how this affects directly to the rising cost of living that's affecting mortgage affordability? Terry, your thoughts on that one?
Yeah, well, we started the broadcast by dealing with that issue. We don't think that with what's in prospect with interest rates, that it's going to have a major impact because there are more powerful forces. It obviously does affect families' budgets, but if we get through the year with just maybe one or maybe two more interest rate rises, then the impact on real estate markets is going to be quite muted, I think.
Yeah, got it. I think people are budgeting now for one or two more rate rises, and it's a pain in the butt to have to pay more interest, but it's just the cost of buying houses, and it's certainly not going to get cheaper.
Yeah.
Wayne's asking, how do we get the government to reduce some of the fees and taxes which make up 48% of the cost of a new home? Great question, Wayne. I think you should be writing submissions to the government about this one as well because it's an ongoing issue. So, yeah.
It is the issue as far as I'm concerned.
Yeah, yeah.
And, while politicians like to say how much they care about affordability, they're causing the problem with their various policies, and taxation is a huge part of it. What Wayne says is correct. Anywhere in Australia, somewhere between 40 and 50% of the cost of a new house and land package is basically taxation, taxes, fees and charges. All three levels of government are part of the problem. They're never going to let go. That kind of revenue is like cocaine to politicians, and they're just not going to let go of it.
And also, Terry, it's not very populist to say, hey, we're going to reduce the cost of infrastructure charges or taxes because that doesn't get a political vote compared to saying, hey, we'll give you a no cost of getting 5% deposit, right?
Yeah,
So
that's
it's just a
right.
populist policy.
Yeah, I mean that at the last federal election, they had an opportunity to deal with some of these issues, but that they went for the cheap and nasty option, which was to throw money at first home buyers, thereby making the affordability problem worse, and the cost of building new homes continues to be obscenely high. So I don't know how we get them to deal with that. Wayne, short of putting a gun to their heads, but
All right. David's asking, what's Brisbane's market going to look like after the Olympics? Very good question, 2 or 3 years later. David, I think Brisbane has got a very, very good trajectory. It's not just the Olympics that's making Brisbane grow. If you look at charts of the volume of interstate migrants moving around Australia, Brisbane, Gold Coast, and the Sunny Coast gets the highest share of interstate migrants. And it's not going to stop after the Olympics. It's going to continue. So again, affordability, lifestyle, all those drivers we've been talking will continue to flow into into the Brisbane market after the Olympics. So I think it's going to look very, very strong. I doubt there's going to be much of a dip. It's just going to be a bit of a spike of interest because of the Brisbane Olympics, but I don't expect there to be a massive drop off at all.
yeah.
Someone's asking 5-year forecast for Perth. I think we've covered that. That's already in the document. I'm just conscious of time, Terry. Do you have any thoughts on the commercial real estate market, which has suffered since COVID? What do you think will happen in coming years in Sydney and Melbourne? Yeah, from Anonymous. So whoever's asked this question, there's different elements to the commercial market. We've got industrial, retail, office. Certainly the office market suffered terribly in the work from home scheme. And I think you're starting to see a little bit of recovery now. That market's probably dropped about 25, almost 30% in office, but we're actually starting to see some of the bigger players now regenerating some of the office and trying to bring workers back. There's also been mandates for 3 or 4, even 5 days a week for some staff. So I think that office sector will recover. The industrial sector, very strong demand. Industrial is really good in both Sydney and Melbourne. I think that's going to be really strong. Retail is very site specific. Patchy, probably be my comment about retail. Nandish is asking, Terry, has WA peaked? Well, I mean, it's more just has Perth peaked? It's probably a better question to ask. What's your thoughts on that?
Yeah, look, it appeared to have peaked about a year ago because we were seeing the rate of price growth coming down and down month by month, quarter by quarter, and it reignited somewhat. particularly in the second half of 2025. And I think partly that was government stimulus, not just the federal government stuff, but state government as well, because the end of the market that's strongest is the more affordable end. So it must be close to its peak, but it has reignited, having appeared to have peaked a year ago. So it's but the factor that drove the Perth boom in the first place was that it had such a high level of affordability and great rental yields for investors. That's no longer the case. Perth's now as expensive as Melbourne, and those rental yields, the properties that were 400,000 a couple of years ago now above 600,000, where you could get 6% yields now they're below 4%. So a lot of that investor demand is coming out of that market.
Yeah, right. Shuang is asking, is Tamworth a good place to buy now, Terry? What do you think about the country town of Tamworth, country music festival?
Yeah, I like Tamworth. It's a good, strong regional city. It's got some diversity to its economy, quite a bit of investment in infrastructure going there, government investment, including the renewable energy zone that's centred around Tamworth. And it's got a good level of affordability. It's hard to find those affordable buys in, strong markets anymore, but Tamworth still has some suburbs of medium house prices in the 400,000s. So it's got possibilities, and I think it's going to show some pretty solid long-term growth.
Great. Someone couldn't get the QR code. As I said, we'll be sending that around in the follow-up to this, so you can book in a time through that. Someone's asking, as a general rule, is it better to invest in a house due to the land proportion rather than an apartment? I'm looking at investing with a self-managed super fund, budget 800K, and potentially personal funds too. So if whoever asked that question, I generally invest in houses because I agree it has generally a higher land content. Even though I said before apartments are going to perform possibly stronger in certain areas rather than houses, it's not to say houses overall perform better. In fact, I did analysis, Terry, the last 25, 30 years, looking at Sydney, Melbourne, Brisbane, of house prices versus apartments and the average capital growth rate. What I found was houses rose at between 7.5% to 8.2%, whereas apartments rose at around 5 to 5.5%. So essentially what I was saying is there's a 2 to 2.5% premium in capital growth by investing in houses. So if you've got 800K, historically, correct.
Yeah. And our point is that, yes, we agree historically that's the case, but we think that paradigm is shifting for a variety of reasons, and we touched on that earlier. I think, we're going to see that gap close, and we're seeing more and more instances where apartment prices have risen more than house prices in the same location. One of my broadcasts not so long ago was on the topic of, is land the only thing that people will pay a good price for? Is the lack of land content necessarily a problem? There's other things that apartments can offer that people will pay a top price for, like a view, for example, like proximity to desirable things, affordability, and increasing factor, safety and security. We're in cities like Melbourne, where crime is just such a huge issue, and in the media every day, people are more and more people are saying, well, if I'm on the 5th floor of an apartment building with security features, I'm going to feel a lot safer. So that's a factor as well. So I think that paradigm's shifting, and if you did that calculation 10 years from now, I think maybe the numbers will be different.
They'll be closer together. Yep, exactly.
Yeah.
Terry, 2 more questions. What are your thoughts on Bendigo and Ballarat? What's your thoughts on those lovely Victorian towns?
I do like them. They've had great growth, say from 2020 to 2022, 23, there was excellent growth in Bendigo and Ballarat. They've been on pause, but now they're starting to rise again. In fact, I'm hearing anecdotally there's massive demand coming into places like Bendigo at the moment. Again, both those cities benefit from that population drift out of Melbourne. They offer affordability. They're good, strong regional city economies in their own right. They're well connected to the capital city. Um, the only detrimental feature always with Victoria is the high taxes and the unfriendly state government, which hopefully will change soon. But you do pay more stamp duty than most other places, and you do pay more land tax there. So you've got to keep that in mind. But I think the future for, if you own real estate in Bendigo and Ballarat, if you buy there this year, in 5 years' time, you'll probably be happy you did. Good level of affordability because they haven't had much price growth in the last couple of years. There's still plenty of suburbs in Ballarat where the median house price is in the 400,000. So you can't find that in many good, strong cities in Australia these days.
Great. Look, Terry, we're out of time, but last question. If I had 650 to spend, what town would be best to look at, and how should I invest in a house or a unit? I'll answer that one. I think, Kim, probably the simplest thing to say, honestly, is just book a time in to have a chat with our Director of Property Strategy, because that's for a more personalised question. But again, whether it's a house or unit, is going to be secondary to the location. We want to look at those location drivers first. It's getting harder and harder to buy good locations under 650, Terry. I think we did a seminar once,
Yeah,
where to buy under 500, where to buy under 600. Next year, we'll probably do it where to buy under 700 or 800, right?
yeah.
So,
But Kim, the best answer to that question is the answer. There's no right answer to that question. It depends on you. It always depends on the individual. That's why you need to have a chat with Rich or a member of his team, because there's not a universal answer to a question like that. It depends on you, your family situation, how old you are, how much you earn, what you already own, and where you own it. Will all dictate the answer to that question.
that's it. Yeah. Well, look, Terry, I just want to say a very, very special thank you for your contribution and insights today. It's been fantastic. You're like a walking property encyclopedia, mate. So I love that. And thank you to all our viewers today coming online. We really appreciate your support. Hope you've got some useful information. Please tell your friends to subscribe to my blogs and my market updates, please. And if you do have any interest in working with us, we'd certainly be delighted to help you. We just want to wish you a great day. Thank you for being with us, and we look forward to seeing you again on our next webinar. So bye for now.
Okay, bye.
Thanks, Terry.
You're welcome.